Good morning, everyone. Thank you for joining the Surrey and White Board of Trade. I am Rona Doria, Events and Sponsorship Coordinator of the Surrey and White Board of Trade. I want to welcome you to today's session, Navigating Sale of Your Business, a Lawyer's Perspective. I want to remind you that if you have any questions during this session, please put your questions or comments in the chat function and we will get back to them as soon as we can. If we are unable to answer your questions, we will get back to you after the session is over. Additionally, you can also turn on captions. I acknowledge that we are in the traditional territory of the Coast Salish people, specifically the Kwantlen, Katsi, Coquitlam, Kakait, Semiahmoo, and the Tuasin First Nations. As well, I acknowledge the Inuit and Métis Nations peoples who live and work on these territories. This session is hosted by the Surrey and White Board of Trade, an independent nonprofit organization and concierge of connections for Surrey and White business communities, where we deliver diversified service portfolio of business development, support for international trade, government advocacy, and workplace development. We support business and attract business, which is now more vital than ever before. Check our diversified portfolios at swrbot.com. Your facilitators today are Jason Harris and Maurice Wong from Fasken Law Firm. Fasken is a leading Canadian-based international law firm with 900 lawyers and 10 offices across 3 continents. As the largest law firm in British Columbia, Fasken has over 160 lawyers in Vancouver and Surrey, offering a wide array of business law and litigation services. The firm has long advised family businesses, private and public corporations and partnerships, professional service firms, government and non-profit organizations of all sizes. Clients turn to Fasken for trusted guidance in navigating the complex legal landscape with clarity and proficiency. Jason and Maurice, over to you.
Thank you, Rona. Good morning, everyone, and thank you for joining us today. My name is Jason Harris. I'm a partner at Fasken in our corporate commercial group. I'm based in our Surrey office. I act for businesses at all stages of a company's life cycle. This includes creating best corporate structures for early stage growth and acting for clients in business sales and acquisitions. I also provide advice on exit strategies and business succession planning. Joining me today is Maurice Wong, an associate in our corporate commercial practice group in BC. Maurice advises clients on issues spanning the entire life cycle of a company, from incorporation to dissolution, and has acted for clients on both the buyer side and seller side of many transactions. During today's seminar, Navigating the Sale of Your Business, Maurice will be discussing the sale process, from early stage planning to closing the deal. You'll gain an understanding of the steps involved in the transaction process, key deal documents, and some common pitfalls to avoid. Please submit your questions in the Q&A box, and we'll try to address your queries at the end of the presentation. I will now pass you over to Maurice to begin our presentation.
Thanks, Jason, and good morning, everyone. I'm thrilled to be here to discuss one of the most significant milestones for any business owner, the sale of your business. Selling a business is not just a transaction. It's a process that requires careful planning, legal and financial expertise, and strategic decision-making. Whether you are actively planning to sell or simply exploring your options, today we hope to give you a better understanding of what's involved. There's a fair amount to cover, so let's dive straight in. Selling a business is a complex process, and one of the most critical steps is building the right team of advisors to guide you through it. The sale of a business involves many moving parts, and having experienced professionals on your side can make all the difference in achieving a successful outcome. The first are corporate finance M&A advisors. These professionals can help prepare your business for sale and identify potential buyers. Then we have accountants, who are essential for advising on valuation and tax implications. They conduct tax due diligence, review the tax aspects of transaction documents, and help ensure the funds flow aligns with your objectives. Lawyers provide legal advice on the transaction structure, perform legal due diligence, and draft and negotiate transaction documents such as a purchase agreement. They also coordinate the execution and closing of the transaction. Finally, depending on the specifics of your business, you may need additional advisors such as environmental consultants, intellectual property specialists, human resources experts, or regulatory advisors. Building the right team matters because each advisor brings unique expertise to the table, helping you navigate the complexities of selling your business while protecting your interests. Engaging advisors early on allows them to identify potential issues and help you develop a plan to address them. With a strong team, you'll be ready to handle challenges, negotiate effectively, and achieve a successful outcome. For an overview of a transaction, let's take a moment to look at a flowchart setting out the various stages. This outlines the key steps in the early stages, and we'll look at these stages in more detail in the following slides. The process begins with getting your business ready, which involves laying the groundwork for the sale. The next step is to execute a non-disclosure agreement, or NDA, to protect confidentiality. From there, you'll move into initial disclosures, providing basic information about your business to gauge buyer interest. This sets the stage for negotiating the letter of intent, or the LOI, which outlines the major terms of the deal. Finally, the process transitions to due diligence, where buyers review detailed information about your business. Now, let's look at the flowchart for the later stages of the transaction, which focus on closing the deal. Once due diligence is complete, the next phase begins with drafting transaction documents. This includes the purchase agreement and any other supporting agreements. After documents are signed, the transaction moves into one of two closing structures. For a one-step transaction, signing and closing happen simultaneously. For a two-step transaction, signing is followed by an interim period before closing, during which certain conditions must be satisfied. Finally, the transaction concludes with closing, where ownership officially transfers to the buyer. That's not all, though. Even after closing, sellers often have post-closing obligations to fulfill. For buyers, the post-closing focus shifts to integrating the acquired business or assets with their existing operations. How can a sale be structured? Let's start by discussing an asset sale, which is one of the two primary transaction structures for selling a business. In an asset sale, the buyer acquires specific assets and assumes selected liabilities, rather than purchasing the entire company. This structure allows the buyer to tailor the transaction to their needs, picking and choosing which assets and liabilities to acquire. For example, assets can be accounts receivable, business names, contracts, equipment, inventory, goodwill, property, and trademarks. Liabilities that may be acquired include accounts payable, employee liabilities, or lease obligations. The seller retains a legal entity and may decide to continue its remaining operations or wind down. However, asset sales are more complex. They require individual asset transfers, which can involve significant paperwork, such as obtaining third-party consents and re-registering licenses. Buyers may need to renegotiate contracts with customers, suppliers, or employees to ensure ongoing relationships. Now, let's introduce the share sale, which is the second transaction structure and is a more common option in Canada. In a share sale, the buyer acquires ownership of the company by purchasing shares from the shareholders. This means all assets, liabilities, and contracts remain within the company, and the buyer assumes control of the entire legal entity. Share sales are typically preferred for businesses with ongoing operations because they provide continuity for employees, customers, and suppliers. They also avoid the logistical challenges of transferring individual assets, making them simpler to execute. We'll expand on share sales in the next slide. So taking a closer look at a share sale, there are several advantages for buyers. If the company has an established brand, strong goodwill, and a solid reputation in the market, a share sale is often the preferred option. This structure allows the buyer to capitalize on these intangible assets, preserving the company's identity, customer relationships, and market presence. As contracts, business names, leases, and intellectual property are already in the name of the company, there is no need to formally assign contracts or other property, and therefore third-party consents may not be required, although they often are. As mentioned, share sales ensures contracts, licenses, and permits remain intact, avoiding the need for individual asset transfers or renegotiations. This minimizes disruption for employees, customers, and suppliers. There are some disadvantages for buyers, however. In particular, the company retains all liabilities of the business on completion, including any tax liabilities of the company. Even if the seller provides an indemnity for the liabilities incurred up until the date of closing, unless an amount representing the value of these liabilities is set aside, for example, held on trust as security, or there's a bank guarantee, there is a risk that the seller may not have the funds to indemnify the buyer when actually called upon to do so. There are also some contracts that will require third-party consent or a change in ownership. Buyers must identify these contracts during due diligence and work with the seller to secure the necessary consents before closing. And also, after thorough due diligence, certain liabilities may remain undiscovered, creating potential exposure for the buyer. For sellers, advantages in a share sale. First, there's a clean exit. Sellers transfer ownership of the entire company, including liabilities, to the buyer. This reduces post-closing obligations, and there may be a better overall return for the shareholder in a share sale transaction. As already mentioned, there's less effort and risk associated with ensuring customers, suppliers, and employees will stay with the company after closing than in an asset sale. Of course, there are some disadvantages as well. Seller may be required to provide extensive warranties and indemnities. These, unless limited, could be required for a significant period of time. Also, as already mentioned, part of the purchase price may need to be held back on trust, or the sellers may need to provide a bank guarantee as security for a breach of warranty, which may expose them to further personal liability. There is also the possibility of preemptive rights. So sellers must review any restrictions on share transfers, which might be contained in the company's constating documents or articles or shareholder agreements, which means that there may be additional consents required to be obtained, this time from other shareholders. While outside the scope of this presentation, for sellers, it is also important to understand the tax implications of a share sale and an asset sale, as they may be taxed at different rates. And for that, you should talk to your accountant for further information. So now let's talk about the early stages of preparing your business for sale. This phase is all about laying the groundwork to make your business attractive to potential buyers and be ready for the rigorous process of due diligence. One of the first steps is ensuring your corporate governance is in order. Start by having your legal team review your company's minute books and corporate records to ensure they are complete and accurate. Buyers will scrutinize these documents during due diligence, and any gaps or inconsistencies can raise red flags and slow down the process. Also, focus on financial readiness. Work with your accountants to organize your financials and ensure all filings are current. You may also want to consider commissioning a quality of earnings report, which independently validates the integrity of your financial statements. These reports can be incredibly valuable during negotiations, as they provide buyers with the assurance that your business's financial health has been thoroughly vetted. Operational readiness is another key area to address. Documenting key processes, supplier and customer relationships, and employment arrangements is essential. For many companies, these arrangements are not formally documented, which can create challenges during due diligence. At the very least, you should be prepared to describe these arrangements clearly for the buyer's assessment. For legal compliance, make sure all licenses, permits, and regulatory approvals are valid and up to date. Additionally, work with your legal team to review your key contracts to ensure they allow for assignment or change of control. Finally, it's important to address any pending litigation or disputes before entering the sale process. Unresolved legal issues can scare off buyers or negatively impact your valuation. Buyers will want to see a business that is clean and free from potential legal liabilities. So moving on, the next step is the NDA and initial disclosures. Confidentiality is absolutely critical during the sale process, and this is where NDAs play a key role. They protect sensitive information, allowing you to share details with potential buyers while minimizing the risk of misuse. They are essential in setting the foundation for initial disclosures and ensuring trust between both parties. There are two main types of NDAs. One-way NDAs protect the seller's information only, which is common when the buyer provides little or no sensitive data during early discussions. For example, if the buyer is simply evaluating your business and hasn't shared financial or strategic details, a one-way NDA may be sufficient. A bilateral or mutual NDA protects both parties' information, and it's typically used when the buyer shares sensitive data, such as their funding arrangements, investment strategies, or plans for integrating your business. NDAs are designed to restrict the disclosure, use, and sharing of sensitive information with third parties. They often include provisions for the secure return or destruction of information once the sale process ends, ensuring confidentiality remains intact even if the deal does not go through. For sellers, confidentiality is not just about signing an NDA. It's also managing internal awareness of the sale process. At this stage, it's wise to limit knowledge of the sale to essential personnel only. This helps avoid unnecessary uncertainty or disruptions among employees, which can negatively affect operations and morale. Another key consideration is how information is shared with potential buyers. You'll want to ensure your deal team has tight control over sensitive documents. Using virtual data rooms is an industry standard for securely sharing information. These platforms allow you to monitor access, set permissions for specific documents, and track who views them. It's also worth noting that confidentiality doesn't end at this stage. Even after the sale is complete, NDAs, the purchase agreement, and any non-competition agreement may also include ongoing confidentiality provisions to ensure sensitive information about your business remains protected. Let's talk about the letter of intent, which is one of the most critical early steps in the business sale process. Think of the letter of intent as the roadmap for your transaction. It's typically the first formal document exchanged between the buyer and seller, and its purpose is to outline the major terms and conditions that will guide the deal. By setting expectations up front, the LOI helps reduce misunderstandings, streamlines negotiations, and keeps the process on track. Although the LOI is usually non-binding, it establishes a framework for the definitive agreements that follow, such as a purchase agreement. At its core, the LOI is about alignment, ensuring both parties are on the same page before investing significant time and resources in drafting final documents. The LOI typically includes several key provisions. First, it specifies the indicative purchase price, often with adjustment mechanisms like working capital adjustments to reflect the company's financial position or earnouts to reflect future performance. It also clarifies the deal structure, whether the transaction will be an asset sale or share sale, depending on the goals of the buyer and seller. Payment terms are outlined as well, detailing how the purchase price will be paid, whether in cash, vendor financing, earnouts, or a combination, as well as when these payments will occur. There will be covenants, such as non-compete or non-solicitation clauses. And the LOI also identifies conditions to closing. So, for example, regulatory approvals, financing arrangements, and completion of due diligence, which must be satisfied before the transaction can close. While risk allocation terms are finalized in the purchase agreement, the LOI may outline preliminary frameworks for indemnities, liability caps, and survival periods for claims. Even though most of the LOI is non-binding, certain provisions are binding, such as confidentiality clauses, exclusivity clauses to prevent the seller from negotiating from other buyers for a specific period, and there may be break fees imposed if a party withdraws from the transaction without cause. When drafting an LOI, it's important to avoid overly detailed commitments that limit flexibility for future negotiations. Always have your LOI reviewed by your lawyers to ensure enforceability and minimize risk. The LOI is a tool to identify potential challenges early and ensures that both sides share the same vision for the transaction before moving forward. So, due diligence is one of the most critical phases in the business sale process. For sellers, due diligence is typically managed by the seller internal team as well as its external advisors. The seller's role is to provide the required documentation to facilitate the buyer's review. Information is primarily shared through a secure virtual data room. Buyers may also review publicly available information such as corporate filings and searches. The process begins when the buyer issues a detailed due diligence request list outlining the specific documents and information they need to evaluate the business. Timely and accurate responses to these requests are essential to keep the process running smoothly. Sellers may also conduct Q&A sessions to address gaps or clarify details, ensuring the buyer fully understands the information provided. Due diligence serves three key purposes. First, it confirms the accuracy of representations and warranties in the purchase agreement. Buyers use this phase to verify that the business or asset they are acquiring are as described. Second, it identifies risks that could affect valuation or deal structure. These risks might include tax liabilities, operational inefficiencies, or unresolved legal disputes that could impact the buyer's decision-making. Finally, due diligence informs negotiation of key terms, such as indemnities, covenants, and closing conditions. Buyers may request adjustments to address specific risks, such as liability caps, holdbacks, or even changing the purchase price. As we're not accountants or financial advisors, we'll just take a quick look at the first main type of due diligence, financial and tax due diligence. Buyers focus on financial due diligence to assess the sustainability and health of the business. They review key metrics such as the quality of earnings to determine whether reported revenue and profits are reliable and sustainable. Another focus is working capital and cash flow, as buyers want to ensure the business has sufficient liquidity to operate effectively after the transaction. In addition, buyers evaluate liabilities and contingencies such as debt levels and payment obligations to understand the company's financial obligations. When it comes to tax due diligence, buyers review tax filings to confirm they're accurate and up to date. They also examine indirect taxes and payroll tax compliance, as well as unpaid taxes or penalties that might create issues after closing. The findings from financial and tax due diligence can have a direct impact on the transaction. Buyers may propose purchase price adjustments based on working capital levels or identified liabilities, and they may request indemnities to address specific risks. In some cases, significant financial or tax concerns could even lead buyers to prefer an asset sale over a share sale. The second main type of due diligence is operational due diligence, which focuses on the day-to-day aspects of your business, helping buyers understand how it functions and whether there are operational risks that could affect its performance after the sale. For instance, buyers assess the stability and reliability of supplier relationships and customer contracts. Buyers also evaluate the workforce by reviewing employment agreements and organizational charts to understand the overall structure. Another key area of focus is whether your operations comply with industry regulations and standards. Buyers will look for any risk related to noncompliance that can lead to disruptions in the future. Finally, buyers assess how easily your operations can be integrated into their own systems and processes. This includes evaluating whether your business's workflows, technology, and management structure align with their existing operations or require significant changes. Like financial due diligence, operational due diligence findings can influence evaluation, closing conditions, or even post-closing obligations, such as transition services. The third main type of due diligence is legal due diligence, which focuses on the legal aspects of the business. Buyers will start examining your corporate records, including minute books, shareholder registers, and any amendments to your company's constating documents. Contracts are another major focus. Buyers will review agreements with employees, customers, suppliers, landlords, and so on to confirm they are transferable or include change of control provisions. If contracts have these provisions, third-party consent or renegotiation may be required, which can delay the transaction. For regulatory compliance, buyers will verify all licenses and permits are current and valid. Outstanding or historic litigation is also assessed. Whether it's pending lawsuits or past disputes, unresolved claims can impact the buyer's risk tolerance. Finally, the buyers will want to confirm ownership of the shares in a share sale and key assets, such as real estate, intellectual property, and equipment, to ensure there are no encumbrances or disputes over ownership. Buyers need assurance that these assets are fully transferable and free of complications. For sellers, legal due diligence is about providing the necessary disclosures while protecting yourself throughout the process. First, due diligence findings impact the representations and warranties you'll make in a purchase agreement. These are the formal statements you provide about your business, such as confirming your contracts are valid and that you are in compliance with applicable law. If the buyer discovers issues, they may request more detailed disclosures and broader warranties to address specific risks. Second, legal due diligence shapes indemnity provisions, which protect the buyer from financial losses caused by undisclosed liabilities or breaches of warranties. For sellers, this means negotiating limits on your liability, such as caps on indemnity amounts or survival periods, to reduce long-term exposure. Third, due diligence findings affect closing conditions, which are the requirements that must be met before the sale is finalized. Finally, due diligence drives the negotiation of risk allocation and post-closing obligations. Buyers may request holdbacks or escrow arrangements to manage risks identified during the review. Sellers should work closely with advisors to negotiate fair terms and ensure their interests are protected. In terms of transaction documents, the purchase agreement is a definitive legal document that formalizes the terms of a sale. This agreement is primarily managed by the legal team, which drafts and negotiates the terms. While lawyers handle the legal aspects, the internal deal team provides input on business and financial terms. The purchase agreement differs from the letter of intent. While the LOI sets out the general terms and conditions of the transaction, the purchase agreement is where these are fleshed out fully, and these are where they're made binding. There are several key negotiating points in the purchase agreement, and these have already been covered, and they should be addressed in the LOI. First, there's the price, which covers how it is calculated and any adjustments that may be required in timing of payments. Next are the reps and warranties, which we've discussed already. The reps and warranties will be backed by disclosure schedules prepared by the sellers, where the sellers can make certain disclosures against them so that buyers are aware of them before the sale and ultimately protect the sellers from a future claim. Indemnities are another critical point. Negotiation often focuses on the scope of the indemnities, so what they cover, liability caps, which would be the maximum amount the seller is responsible for, baskets, which refers to thresholds before claims can be made, and survival periods for claims, which is the time period for the buyer to make a claim after closing. Sellers will want to limit their exposure, while buyers want broad and robust protections. If there is a split sign and close, the purchase agreement will include rules to govern how the business is managed between signing and closing. For example, sellers may be restricted from entering into new contracts, incurring debt, or making significant changes without the buyer's consent. There will also be restrictive covenants, which we've mentioned already, such as non-compete, non-solicit, and confidentiality obligations. These are typically time-limited and geographically specific, but they must be carefully negotiated to balance the interests of both parties. In addition to the purchase agreement, there are several other transaction documents that play a critical role in the business sale process. One of these is the escrow agreement, which governs purchase price holdbacks. Funds would be held by an independent escrow agent and released based on agreed conditions, such as survival periods for claims or resolution of specific risks. This type of formal arrangement is common in larger transactions where financial protections are required. Another important document is the Transition Services Agreement. This agreement is designed to ensure operational continuity after closing. Sellers may agree to provide temporary support for areas like IT systems, HR functions, or finance functions for a defined period to help the buyer integrate the business and avoid disruptions. If the seller will be a minority shareholder in the buyer's business, you will need a shareholders agreement. This document governs the rights and obligations of the shareholders moving forward and outlines decision-making processes, voting rights, dividend policies, and other governance matters. We've already mentioned non-competition obligations. Often this is set out in a standalone agreement. And then you'll also have employment agreements. So these would be for employees retained after the transaction. These agreements set out the terms of employment under new ownership. So moving on to closing the deal. And this is when we've negotiated all the documents and the parties are now ready to proceed. Signing is a key milestone. At this stage, the agreements between the buyer and seller become legally binding and both parties formally commit to the terms of the deal. The structure of signing and closing can vary depending on the complexity of the transaction. In simpler deals, signing and closing happen at the same time, and this is a one-step transaction. This is typically used when there are few conditions satisfied. So signing and closing simultaneously lets the transaction be finalized quickly. For more complex deals, signing is followed by an interim period before closing, and this is a two-step transaction. During this time, certain conditions must be satisfied before the sale can be completed. These conditions often include regulatory approvals, such as competition law clearance, license transfers, financing arrangements where the buyer secures funding for the transaction, and third-party consents from customers, suppliers, or landlords for contracts with chain of control provisions. For sellers, it's critical to ensure that conditions to closing are clearly defined and achievable. Ambiguity or delays in satisfying these conditions can create uncertainty or even jeopardize the transaction. Work closely with your advisors to understand and fulfill these requirements. In a two-step transaction, the interim period occurs between signing and closing. During this phase, the purchase agreement is signed and locked in. but the transaction remains subject to specific conditions. We've already mentioned some of these conditions that might need to be fulfilled during this period. The seller plays an important role during the interim period because they must continue operating the business in the ordinary course. And the seller will be required to do this through covenants and restrictions set out in the purchase agreement. So, for example, the seller will need to avoid making major changes to the business without the buyer's consent, such as entering into new contracts, incurring debt, or making personnel changes. Additionally, sellers are usually asked to provide timely updates to the buyer regarding the company's performance and any developments that could impact the business or the transaction. The interim period comes with risks and considerations that both parties must navigate. Buyers will often seek oversight and approval rights during this phase to ensure the business is managed appropriately. The sellers will want the covenants not to be onerous as much as possible. As such, it's essential to understand your obligations under these covenants and restrictions, as a breach could trigger termination rights or remedies for the buyer. So once all conditions to closing are satisfied, closing takes place, marking the official completion of the transaction. This is a moment when ownership of the business or assets transfers to the buyer, and the seller's obligations largely conclude, apart from any post-closing covenants. At closing, there are several key deliverables that both parties must exchange. First, the buyer transfers the agreed-upon purchase price to the seller. Next, ownership is formally transferred, whether through the transfer of shares in a share sale or the transfer of individual assets and selected liabilities in an asset sale. This is also when both parties exchange closing documents, including signed agreements. For buyers and sellers, it's critical to ensure all deliverables are prepared well in advance of closing to avoid delays. The parties will also want to confirm that all conditions to closing have been satisfied. To support the closing process, lawyers will typically prepare a detailed closing checklist that outlines each party's obligations and deliverables. Both parties will carefully review this checklist to ensure the transaction closes smoothly and successfully. Even after the sale is finalized, there are important post-closing obligations that sellers must fulfill to ensure the transaction is fully complete. These activities are typically managed by the internal deal team in conjunction with lawyers who oversee the process to ensure all requirements are met. Post-closing, the buyer will update corporate books and records to reflect the change in ownership and other necessary amendments. It is also essential to communicate these changes to key stakeholders, including suppliers, customers, employees, and other parties connected to the business. The parties may need to update or apply for new permits and licenses, depending on the nature of the business. Regulatory filings and tax reporting must also be completed to satisfy requirements following the sale. In addition to administrative tasks, sellers must address post-closing covenants and obligations outlined in the purchase agreement. This includes finalizing working capital adjustments to reflect the financial position of the business at the time of closing. The parties must also calculate earnouts or deferred payments if all agreed upon metrics are met. Sellers will need to comply with restrictive covenants relating to competition and solicitation. So these would be not to compete against the buyer's business and not to solicit employees of the business after closing. There will also be confidentiality provisions and transition service obligations, all of which are designed to safeguard the buyer's investment and ensure business continuity. The sellers must carefully keep track of timelines for adjustments, earnouts, and other post-closing deliverables to avoid disputes or penalties. After the sale is finalized, the focus shifts to integration, which is managed almost exclusively by the buyer's deal team and other members of the company. Integration is a critical phase where the buyer merges the acquired business into their existing operations, ensuring it functions as a unified entity. The length of the integration period depends on the features of the business. For some transactions, integration may be completed quickly, while others, especially those involving complex operations or significant changes, may take months or even years. So, as we approach the end of the presentation, here are some final thoughts about preparing your business for sale. Start early and know your options. Explore different deal structures with your corporate finance team and accountants, and evaluate potential buyers carefully. Consider factors like timing, tax implications, and long-term goals to choose the best approach for your transaction. Engage advisors who are appropriate for your transaction. Selling a business is a complex process, and having the right experts on your team is essential. Depending on the transaction, you may wish to work with your existing day-to-day advisors or consider bringing in transaction-specific advisors to push you over the line. Preparing your business for sale takes time, so begin organizing your financials, contracts, and documentation well in advance. This will help avoid delays and build buyer confidence. Then plan for post-closing obligations. Think about the transaction itself and consider what comes after the sale. Post-closing activities like integration and transition support are critical to ensuring the business continues to thrive under new ownership. Address these areas early to make the transition as smooth as possible. And then communicate internally and manage confidentiality. Throughout the sale process, it's important to keep sensitive information secure and prepare key stakeholders, such as employees, customers, and suppliers, for change. Selling your business is not just about finding a buyer. It's about creating a strategy that maximizes value and ensures long-term success. So thank you for attending today's webinar. I hope this, sorry, Jason.
Yeah, thanks, Maurice. Maurice, we have a couple questions, and if anyone else has questions, you can post them in the chat there. So the first question, Maurice, is how long does the process usually take from start to finish? And also, we're often asked this: how much do lawyers charge for the work that they do?
I think it depends on the deal and on the transaction. Obviously, like more straightforward deals can be, the process can take a shorter period of time, whereas more complex ones could be, months between each stage. I mean, that's also your experience, Jason?
Yeah, and it's hard to know how much a transaction will cost until you get into it.
Yeah.
And usually, like if someone's curious about how much legal fees could be, usually the best suggestion is to meet with a lawyer. First, you should meet with a lawyer anyway to make sure they're going to be the right fit for you. But during that initial consultation, that lawyer will want to learn about the transaction and will probably be able to give you a general idea of what to expect, but it's really not until you get into the details of the deal. You just never know the variables that could come up, and also it also depends on who's acting for the other party to the transaction. So if you're selling, who's acting for the buyer, and some lawyers are more difficult than others to deal with, so that can always be a factor into the total cost of the transaction. We have another question here. There's multiple parts to a sale. Who acts as the head coach? Who, I guess, takes the lead in the transaction? And I think it depends on the which stage you're at. Lawyers usually get introduced to the transaction unless it's their client that's selling or their client that's interested in buying. They're not usually first into the transaction. And so it may be the client's accountant that kind of starts things, or they may go to a corporate finance M&A advisor. They would take the lead in the early stages, and then at some point it gets handed over to the lawyer. Usually, after the LOI has been signed and you're into the due diligence, and when you get into the stage of preparing the definitive agreements, usually that's where the lawyer steps in to kind of take the lead at that point. And if there is an M&A advisor, they're usually involved from start all the way to the finish line. But it's usually at that point where you're dealing with the definitive agreements that the lawyer takes the lead and quarterbacks it to the finish line.
Yeah, I was just also going to add that sometimes or quite often the corporate M&A advisors will take the lead on the due diligence, which is obviously very helpful. But sometimes they also include all the legal due diligence requests as well. So at that point in time, it might be worth speaking to a lawyer to make sure that those legal requests cover everything that you want to cover.
Yeah. Another question here is are letters of intent always used, or is it okay to go straight to the purchase agreement?
I suppose the answer is no, they're not always used, but it's usually more efficient if all the parties are starting from the same point and have at least a high level agreement on the transaction. Because if the parties have agreed a letter of intent, like a good one, then that kind of guides everything that comes after. So you will be more efficient when negotiating certain points, certain items, or when preparing documents. You kind of already are on the same page. So it's just kind of like sorting out the nitty gritty.
Yeah, and I'll add that the letters of intent, the LOIs, they're not, most of the LOI is not enforceable. It's just to get the parties on the same page with respect to the key terms. And you mentioned, obviously price and how that's calculated, how that'll be paid, what the buyer is buying, so how the deal is being structured, whether the owner is going to stay on with the business post-close, and for how long, on what terms. Is it just a transition period? And non-compete, what's going to be expected of the owner in terms of a non-compete. I've got clients that kind of want to rush through it, but it's important to take your time. It's not a lengthy document, but it's important to make sure that the terms that are set out there, although it's not binding, it's important to make sure that the terms reflect the deal that you want, because you really need to manage those expectations. It's difficult for a seller to try to change the terms that are in an LOI later. So it is an important document. It does make sure that the parties are on the same page, because after that, as you mentioned, Maurice, it's going to get real in terms of time and fees. Like that's, at that point you're getting into the due diligence stage, and it's very time consuming, and you're going to have professionals involved, and you're going to be paying the fee. So it's important to make sure everyone's on the same page, at least on a non-binding basis. So I like the letters of intent. I usually recommend them, but they're not always used. Here's another question. Looks like this person's been approached. Someone's interested in buying their business, and they want to see their financials, and they're just wondering how much to disclose to that prospective buyer. Yeah.
I think before disclosing any information, they should really enter into an NDA between the parties, just so you could get some reassurance that this prospective buyer will only use whatever information that you share with them for the purposes of this proposed transaction.
Yeah.
I suppose once you have the NDA, then I mean, yes, eventually you do share your financials with the buyers.
Yeah, and I think that if you've got a M&A advisor, they'll often help with the NDA. They'll have, sometimes a lawyer look at it. It's a good idea. And they'll be able to guide the client through those early disclosures. If you don't have an M&A advisor, then it is good to get some advice. You don't have to disclose everything early on. You can get that NDA and then do some preliminary disclosures on the financials, and you can redact information also. So you don't have to disclose everything. You can do general disclosures. You can redact client or customer names, so you're not giving that away in the early stage. But yeah, Maurice, it's important to get that NDA signed before disclosing, and they're difficult to enforce. Hopefully you can if you need to, but the other way to protect your information is being careful how you disclose it, and when you disclose sensitive information, it's usually not early on in the process. There's another question about which advisor is best positioned to draft an LOI.
I mean, I think the lawyers typically draft an LOI, but I mean, quite often the LOI can be produced internally by the company itself. If it's done this before, obviously you'll need input from your advisors as well. Like you'll need the corporate finance people, you'll need accounting people for certain sections of it. So I think the answer, I mean, it's usually a group process, I think.
Mm-hmm.
But yeah, I mean, lawyers have prepared them, and I mean, we've come across instances where the client prepared with input.
Yeah, so some clients they do a number of transactions, so they may have a form of LOI that they've used in the past and that it has worked and they want to use going forward. Yeah, I think that it's always good to have a lawyer have a look at it. And an M&A advisor, same thing. They may take the first draft of an LOI if they're familiar with those, but usually it would be looked at by a lawyer. So it may not be the lawyer that does the initial draft. If you've got a form of LOI that's worked for you in the past, or you've got an M&A advisor that has a form they like to use, but usually a lawyer's eyes does look at the LOI before it gets signed, because although non-binding, it's still important to make sure it clearly states the deal you're wanting.
That's right, and there will be a couple binding provisions in there as well. So just make
Correct.
sure.
Yeah, good point.
Yeah.
One last question here. Yeah, this is always a sensitive one, I find, is an owner's got their business that they're selling, they're into the deal, and buyer wants to speak to the employees, and obviously a buyer's sensitive or seller's sensitive about that. They may not have a signed deal yet. What's your experience in terms of when employees actually are told about the business being sold?
Usually, like there will be some key employees who will be part of the process from the very beginning, so they will form part of your internal deal team. And so, for example, they will be the ones where, operational due diligence, those questions would kind of go to them to answer. But for the other employees, quite often, it's just announced as part of the closing process. So on closing itself.
Yeah, that's my experience also. Yeah. Okay, well, I think that's all for the questions. So that, I guess, wraps up today's presentation. We hope that you found it informative and helpful. And if you have any follow-up questions, you're more than welcome to email those questions to surrey@fasken.com. And we'll try to get back to you on that. And thank you for joining us this morning.
Thank you, Jason and Maurice, for being with us today and sharing this important information. You've highlighted the critical need to prepare for the sale and succession of your business and the many steps involved for a successful transaction. We will be sending you the recording and the facilitator's contact information after this session. Many more of these types of sessions are coming up, so please be sure to check our website at swrbot.com. Make it a great business morning, everyone.